Hello and welcome to the second episode of Eagle Investors Market Recap. My name is Vishu Namburi, and today is Sunday, March 29th. In this episode of Eagle Investors Market Recap, I'll be going over monetary policy, the current government stimulus plans, coronavirus updates, the elevated implied volatility within auctions, the flattening of the yield curve, inflation expectations, and how that can impact certain assets, and solvency issues for companies as well. And with time permitting, I'll be going over a trade recap and some future trade ideas as well. So just to start, I'll share my screen. So just to start off with what we saw with what the Fed was doing. So with the monetary policy, we saw the Fed release on Monday around 8 a.m. They said that they would be open to buying ETFs of corporate bonds. They're currently looking into potentially buying stocks as well. Currently, it's not within their reign to buy stocks, but they're trying to change government policy so the Fed can buy stocks. This would be something that would be substantial and something that investors should keep an eye out on. They also provided a commercial paper funding facility. They provided a term asset-backed securities lending facility to lend money so institutions can buy asset-backed securities. We saw the Fed provide a financing bridge to investment grade rated companies, as well as the Main Street Business Lending Program, which is aimed specifically at lending to small and mid-sized businesses. In terms of the government stimulus bill, we saw direct payments to individuals, also known as helicopter money, to individuals who are under a certain income level, and the payouts differ based off what your income level is as well. And we saw within the stimulus bill, we also saw key unemployment benefits, as well as a $500 billion lending program. Some other smaller parts of the bill included the delaying of the interest loan payments for student loans as well. And within this $500 billion lending program, you saw money specifically go towards the airline industry as well. And we saw a brief rally throughout the week as a result of this. The SPY currently is down 22% year to date, but this week we saw the SPY recover, and it's currently up at 11% for the week. And the key reasons for this rally is we saw a change in investor sentiment. And as I said, with the monetary policy provided by the Fed, we were seeing some of the key credit markets starting to loosen up. And as a result of that, we saw equities start to recover as well. We're seeing the stimulus programs take into effect currently. So we could see this rally potentially continue, but I believe we are not at a bottom yet. In terms of how much further this rally can go, I believe that the S&P 500 might have room to go up 100 to 200 points from here. But then after that, I feel like we will see a significant downturn. There are still many risks, and the coronavirus itself has not reached its peak. Coronavirus stats currently, as of reporting this on Sunday, we've seen worldwide, we've seen over 713,000 cases. And within the US, we've seen over 136,000 cases as well. And we're seeing within Italy and Spain, they're using all their resources within their hospitals, and it's gotten so bad that doctors have to decide who they're going to take, even though many of these patients are in serious conditions. It's getting very bad in Italy and Spain, and in terms of numbers, we're seeing an increase in numbers also within France and Germany as well. So the peak is yet to come, and I maintain the thesis where we won't see a full market bottom once the cases peak within the United States and Europe, and we may see some short-term rallies here and there as we do that as is typically seen with bear markets. Now, in terms of the chart that I have in front of, this is showing the yield curve. So we're seeing the significance of the Fed's actions within their monetary policy. So we're seeing the Fed flattening the yield curve. They're selling a short-term dated security, a short-term dated treasury securities, and buying ones that are at later dates. And by doing this, they're effectively flattening the yield curve, as you can see with this chart. In terms of repurchase agreement operations, we're seeing the Fed continuing to put money to stimulate the economy. And with the passing of the government stimulus bill, you're seeing before the passing of the stimulus bill, you saw a bottleneck effect because the Fed didn't have as much leeway to provide all these programs. But now that they can, you're going to see this money pour into the economy as the government approved some of their operations. In terms of inflation expectations, we saw a big rise in inflation expectations once the Fed announced that they're releasing these plans. The Fed is putting so much money into the economy that while lowering interest rates, so there are expectations for inflation to increase. And as a result of this, you're seeing from a fundamental view, you already saw gold rally, but you're seeing a strong viewpoint of gold because the Fed's injecting so much money, the government's trying to inject money as well. You're going to see inflation rise from here. But on the flip side, you're seeing more investors worried about the market and volatility, and you're seeing institutions selling their current positions. So as a result of institutions selling their positions, they have to sell their hedges as well. And when they sell their hedges, you're seeing gold go down as a result. And you're also seeing fixed income get hit as well when you're seeing large sell-offs in the market as well. And that's why people are going towards cash. And there was some strength in the dollar, but we have to see if that's going to continue. If that continues, we could see gold go down further. But from a fundamental view, I believe gold is a good long-term investment, even though it will go down further, most probably if the market has another sell-off. Now, in terms of key economic events to look into this week, on Monday, we're seeing home sales, as well as on Tuesday, we're seeing the Purchasing Managers Index come out for China and the United States and potentially Germany as well. In terms of on Thursday, we're going to see jobless claims again. It came out around 3.2 million. This time around, I believe next time we're going to see just alone within New York and California, there are reports saying claims can go above 3 million for last week. So I believe that we're going to see a lot of those jobless claims go up even more, and we're going to see states that haven't already implemented the shutdown start implementing them, so we can see more jobless claims from here. And then in terms of Friday, we have a very important employment report as well, and we'll get more stats on manufacturing through the ISM and PMIs as well. And then in terms of inflation expectations, going back to here, as a result of increased inflation expectations, you're seeing an increased volatility in markets. You're seeing more of an uneasiness within investors, and they're going into safe havens, but you've seen some investors go into physical gold instead of paper gold. So physical gold, you've seen a spike in physical gold. That's just because gold producers are essentially saying that there's a shortage of gold and that you should be buying these physical gold products. But from reports that I've been reading, this is not true. The short, the gold itself, the gold value, the physical price of gold should be around the same price as paper gold. But you're saying these gold manufacturers pump out reports saying that there's going to be a change within the physical gold and the paper gold prices from here, and they're selling smaller medallions as a result at higher prices. And if you're more interested in that, I recommend listening to the Macro Voices podcast. They spend a good amount of time talking about that. In terms of VIX structures, the VIX is still currently in backwardation. A lot of investors are still worried about the market going down further from here, and they're trying to protect themselves. You've seen some investors buy SPY puts to hedge themselves, or just put their money in cash as well. So you're seeing elevated implied volatility in options, and as a result, you're seeing increased premiums as well. So it's becoming more expensive to trade currently, and the risk reward is much lower as a result of this. Or the potential reward from trading options has become lowered as a result of implied volatility being so high. In terms of other things to look moving forward is how the U.S. is going to brace for impact with the number of cases rising from the coronavirus. And in terms of seeing it on the economy scale, we're going to see leveraged loans become an issue potentially. We're going to see bond markets get potentially hit if we don't see bailouts within multiple different industries. And oil prices could continue to fall as well. Wednesday's crude oil inventory number is going to be important, because if we see oil storage continue to build up, that means that we could see crude oil drop to the teens level, potentially to the 19 level, to the 18 level as well. And this would be disastrous to the oil and gas industry, which is already getting hit hard with crude oil trading at 24. So if we don't see a deal soon within OPEC, within specifically Saudi Arabia and Russia, to try to stop lower their production rates, we could see oil remain at these low levels, and demand is also getting hit. So we're getting a hit on the demand side and the supply side. And in terms of other things to look into is solvency issues for companies. With companies being so much at risk of defaulting, there's the potential to see banks not giving out as many loans. So with this risk, you're going to see a solvency issue. And especially within small businesses, I believe that we could see a lot of these small businesses. I've read reports saying that a best case scenario is 20% of small businesses default as a result of the coronavirus. So we could see further effects as a result of this. And this is one of the key reasons why we're maintaining a bearish approach to the markets, but there are some short-term rallies within bear markets. So with the solvency issues in particular, the reason why we're looking into over-leveraged companies and seeing how they'll be impacted by the virus. As I said last week, we had a position that we exited with Burlington. So they're a company that's over leveraged within the retail industry. And another key point is their retail sales are over 99% of it. It's within their stores opposed to online. So they're heavily dependent on foot traffic within their stores. So that's why we had a position on them. We exited it earlier this week because as a result of the belief that the monetary policy would provide a brief short-term rally. We were looking at key technical levels as well, and we compared it to previous bear market rallies, and we see the potential for this rally to continue for a little bit, like I said before, 100 to 200 points. But then from there, we're expecting a further dump and to test new lows for this year. And in terms of some potential trade ideas that we have, we're looking into we're looking into opening key put plays within the market once we see the market start to top. I personally am looking into I've been holding some call plays over the past week. I'm looking to exit them early next week, and then looking to entering some put plays once the S&P 500 reaches the 2,800 level. In terms of some other plays that I made this week, I bought Boeing at 120, and I sold 20% of the position at 180. I'm looking to sell a majority of my stake in this long position once we reach that the key technical level for the S&P 500. In terms of other trades that our moderators have been looking into, we've been looking into purchasing puts within the oil and gas industry, specifically Ollie, one of our lead moderators, has put out some key trades on PXD and CVX. CVX is Chevron, and other put plays that we have currently open are WWE, Oracle, and gold as well. So these are dated towards April 3rd, and we have some longer expirations to April 17th as well. And another key thing that I wanted to mention is for traders, we're emphasizing portfolio allocations, making sure that you remain protected even though we're taking key risks. With these naked options, there's a lot of risk. They're very risky, and you could see your position potentially go to zero. And as a result of that, we want all portfolios to be allocated properly. So something that I recommend is having cash set aside. So over 50 to 60% of my personal portfolio is invested in cash. And then depending on whether I'm bullish or bearish, I have around 30% within what position I'm taking, and then 10% within the opposite position. So for example, in the short term, I'm bullish with some worries that it'll take with some worries as well. So I'm about 30% invested in puts and 10% invested in calls. Some of our other lead moderators have other opinions as well, so then they would be allocating accordingly as well. So it's important to make sure that you don't wipe your whole portfolio out in a day or two, and have cash set aside and have positions that help your portfolio stay afloat. And then with that, please let me know if you have any other topics that you'd like to learn about within the next episode. And if you have any other comments and concerns, feel free to reach out to me. And hopefully we have a great trading week next week, and stay safe, and see you guys next week.